Hello, welcome to the James Cooley Show. It's your life. I'm your host, Dr. James J.C. Cooley. Wow, we got an absolutely fantastic show coming your way today. We're going to talk about something that I think is so important to all of us is having an understanding that one of these days we're working, if we're doing this, we're going to have to retire. And a lot of times, many of us are not ready for retirement. We don't even save money. We don't do a whole lot of things. But I tell you, I want to get the radio portion going. And then I got two absolutely fantastic co-hosts that's going to host this with me. So I'll tell you what, stay tuned. Let's get it started. Let's do it, Todd.
It's Your Life is sponsored by James J.C. Cooley.
Life is a series of circles and cycles, phases and stages. These are your experiences that teach you the lessons of life. You can either ignore them or embrace them. Welcome to the James Cooley Show. It's Your Life. James is a motivational speaker, author, military veteran, and founder of the James Cooley Foundation. James is here to equip you to strive for greatness and to overcome adversity. It's time to get equipped today for the challenges of tomorrow. Now, here's the host of It's Your Life, James Cooley.
Hello, welcome to the James Cooley Show. It's Your Life. I'm your host, Dr. James J.C. Cooley. I'm excited today. Hey, Todd, I am excited today, man.
All right. It's always good to be on the show with you, running the board, and you always have great guests. Who's on the show today?
Man, I got Joshua Goldsmith, my financial advisor, and I got Dr. Clement Johnson, my
got
great
the All-Stars.
Oh, man, yeah. I had to bring the All-Stars in today, man, because what we're going to talk about today, Todd, is planning for your retirement. I'm talking about strong retirement. A lot of people wait until they are 50 or 60 to think about, I need to start saving for my retirement.
Too late by then. You shouldn't have put it off that long.
Well, I wouldn't say it's too late, but it's gonna be hard to catch up. So what we're gonna talk about today is how a person mindset, especially when you're younger, developing the right mindset where you are thinking how you go about planting a nest egg for yourself, and not just that, but your family and generations to come. So I got two absolutely fantastic guests on today, and you know what? I don't even have to read their bio because they are absolutely fantastic. So first of all, Joshua Goldsmith, Goldsmith Financial. Just like I said, he is my guy. He keeps me straight when it comes to investing, when it comes to retiring and having the understanding. That's the most important thing, having the understanding on what you might want to look at. He never tell you what you need to do. He say, hey, this is, you might want to think this way. You might want to look at this. You might want to consider this. So we got Joshua Goldsmith on. And then we got my main man, Dr. Clement Johnson. This guy right here, I tell you, a genius as a businessman, entrepreneur. I'm talking about always thinking ahead. He's always ahead of the game and always giving advice to help others. Especially when it comes to life, when it comes to entrepreneurship, when it comes to investing. And so these two guys right here are going to help us out with the discussion. But I tell you, whichever platform you're watching this on or listening to it, if you just listen to the radio, all you have to do is pick up the phone, dial 1-866-577-2473, or whichever platform, was it E360, Transverse Television, was it YouTube, LinkedIn, Twitter, all you have to do is go to the comments and ask us any question that you might have. And I promise you we'll get you an answer. First of all, I want to start off with Josh. Can you tell the audience just a little bit about you so that they can get an understanding of who you are and why you're so passionate what you do?
Sure. JC, first of all, I want to thank you so much for having me on the show. I've been a guest here many times, and I always look forward to being a guest here on your show. My name is Joshua Goldsmith. I have my company Goldsmith Financial, established in 2012. I've been a financial consultant for just over 17 years, and I love what I do. I have my Series 7, Series 66, my health insurance, life and health license for insurance services. And I've been a California certified long-term care certified provider. I help people to understand the pitfalls of long-term care as well. I built my business back in 2008 during recession times when the housing crunch, the original Great Recession happened, by going door to door and meeting people face to face, helping them, giving them personal services, helping them kind of help navigate through those markets and those times. And I haven't looked back at it, and it's been a great career so far.
Wow. So yes, man. That's Dr. Ghost. Now, I want Dr. Clem to tell you all a little bit about him. How you doing, Dr. Clem?
I am doing fantastic, and I'd like to caveat off of what Joshua said. Appreciate you having me on the show, and I also have been on the show several times. Thank Todd for what he does in the background and how he enables this to happen. And hi, everybody. I'm Dr. Clement Johnson. My company is Clemtech LLC, and we're an operational technology networks company. And we focus on industrial cybersecurity, and we focus on connecting those industrial networks to help keep our nation and our nation's infrastructure safe. The way I fit into this conversation is through the lens of a business owner, and of course, protecting myself financially through the financial earnings of my business, but also as a financial client. The successes that I've had over the years, and as you can probably see, I'm not exactly a spring chicken, so I'm here to kind of add some of the groundwork to the end result of proper planning and how I've done it to achieve what I'm able to do in my lifestyle.
Wow. So both of you guys it's going to be an extreme wealth of knowledge to our listeners. Terry, how you doing out there? I see you watching, brother. How you doing? Hey, Josh, I want to start off with you. And that was Dr. Terry Spain, who I was giving a shout out to. Josh, you've been doing this for a while. What would you say is the ideal age? I'm talking about if it was in a perfect world, for someone to start investing, and why?
Oh, great question. As far as the ideal age, really, there, as far as like a sweet spot goes for investing, the sooner the better. Conventional wisdom would say, as soon as you have money, you're making money above and beyond your basic expenses, putting food on the table, rent. You get your emergency fund going. You can save as early as 18. Even younger. I have I mentor one young neighbor's child, and I'm helping them to save. And it's definitely something that can help you to realize goals later in life. People call it retirement planning. I don't like the term retirement planning, JC, because retirement planning seems so far off. It's so far in the future. It's like, okay, so you're saving this, so you're 30. For example, someone 35 years old, and they're saving for retirement, or maybe even 30. Let's say 30 years old. It's hard for them to see, okay, every dollar I'm saving right now, I'm not going to be able to even touch without a penalty for 30 years. The entire duration of their current life. So they've got to double their life, and it took them a while to get to 30 years old. So I like to have people know that they're setting up things not only for, yes, the retirement savings. There's going to be life after their career, or their, or their when they don't want to work anymore, when they want to change their outlook and do other things in life, but also save in a non-retirement account is very, very important. You can invest in the same kind of mutual funds. You can invest in the same kind of stocks and investment ideas, whether it be a real estate investment trust, life insurance product, a unit investment trust. There's all kinds of investment products that go also outside retirement plans where there are no penalties for taking a profit. Let's say, in 7 years, your money doubles at a 10% compounded return. You want to take that money in a retirement account. You're going to roll it over. You're going to keep it in that retirement account, because if you take it out, they penalize you before age 59 and a half. And if you're 30 years old and you saw your money double, now you're 35 or 36 or 37, maybe you want to share in those profits. Maybe you want to take some, have a nice trip with your significant other, or do something fun along the way, because the quantity in life, the consistency, it's about the dash, not the date, if you know what I mean. Like on your headstone you see 1974 to, and then the date that you pass away. It's not about the date that you pass away, it's about the dash. So
wow, I don't want to see that on my headstone, like, hey. I don't know about you, Clem, but
it's all about adding quality to your life along the way. That's my point.
No, I get it. And so there is no magical age to start saving. And I encourage, if you got some teenagers out there, if you got a job right now, you're making some money, you might want to start paying yourself, put a little bit of it away. But we're going to take a station break. But when we come back, we're going to continue to talk about what can we do to have a strong retirement plan, opportunity, whatever Joshua Goldsmith just said. We're going to talk about all of those things. So if you want to be part of this conversation, all you have to do is just go to the platform that you're on. Ask any question that you might have, and I promise you, we'll get you an answer, because it's your life. We'll see you shortly after the break.
There's more stories of greatness to help you overcome adversity coming up on It's Your Life with James.
Really get a chance to know who you are. And once you know who you are, you truly know who you are, love who you are. Love who you are. You're a masterpiece. Love who you are. Love who you were born to be. Love me some me. That's what I'm talking about. When you leave high school, you gotta know today or tomorrow, or hopefully today, what your plans are. Hopefully, there is no bad decision unless there is no plan. Create, collaborate, commit with confidence. Commit with what? Commit with what? In everything that you do.
Now, here's the host of It's Your Life, Dr. James Cooley.
Hello, welcome back to the James Cooley Show. It's Your Life, and I got two absolutely fantastic co-hosts. I'm not calling them guests because they're co-hosts today. You know, again, you got Joshua Goldsmith, Goldsmith Financial. You got the Clem Johnson, Clem that LLC, and yeah, of course, we always got my great producer Todd Pyrie. That's at KCBQ in San Diego, and always doing great work. Making sure that we look good, sound good, and are good. You know, so hey Todd, so what you think about the show so far, man?
Well, it's making me do some self-reflecting on it. I'm like, yeah, do I have my finances all my ducks in a row here? So this is a good motivation for me to make sure I stay on top of those things.
I think it's a good motivator for all of us, and we getting ready to learn. So I tell you what, if you want to be part of the conversation, I already told you. Let's go to the comments, ask any question that you might have. I promise you we'll get you an answer. I'll pick up the phone to dial 1-866-577-2473. Dr. Clem, you know, just going by what Joshua Goldsmith was talking about, there's no certain age to start requirements, or certain requirements for investing other than having an understanding that you need to put some over the way as quickly as possible. Dr. Clem, can you tell our viewers and our listeners of what are some of the steps that you are doing and have been doing to prepare yourself for when you decide that I ain't doing anything. I'm just going to sit back here, just travel and go on vacations and all of those. Hey, Clem, you on mute. You on mute. Dr. Clem.
I'm right here, and sorry about the muting. But one thing I'd like to share is I heard the statements going around that, you know, as you get older, saving for retirement is harder, and all of that is true. But let's put this in perspective. What I learned at a young age is that I could invest a little bit of money, take a higher risk, and later on I can enjoy the fruits of what I've invested in. And as I get older, I want to lower those risks a little bit more. At a young age, you have the opportunity to fully participate in the investment market. You have the opportunity to fully take those high risks so that your retirement is sustainable. As you get older, that's the risk may not be what you want to take. You probably want to, with the little money that you have, you probably want to take less risks. But then you need to kind of figure out what is retirement, and this is what I'd like to share to the viewers. As you get older, as you get in your 60s and as you get in your 70s, the requirements for living aren't what the requirements for living you have, which when you're young. You're not going places, you're not doing the things, you don't need that high class automobile, you're looking to downsize. So I know a lot of us want the couple of $100 million in the bank when we retire, but let's keep it in perspective. The main thing for a retirement income, if you're retiring at retirement age, is first thing you want to take care of is your medical. The medical is the most important thing because that's what's going to eat up your money. The next important thing is your lifestyle. If you've invested early, then your lifestyle could be a little bit more lavish. Maybe you could live in a better house. But let's keep in mind for the older investors, your lifestyle may not be the same as a young investor. However, an extra $400 or $500 a month based on what your investment is still something that is great to have based on a retirement for an older person. So let's keep the investment portfolio in perspective based on your age and how you perceive you want to retire.
Wow. That's great.
I think we kind of lost my video, but you guys can still hear me. I'm gonna work on this one. Hey, Josh, I'm gonna turn it over to you. You got it.
Okay. The just kind of piggyback on what Clem says, like one thing, I mean, you nail it, number one, but to piggyback on that is that oftentimes people overlook the liability side of getting older, getting closer to retirement. So you got to make sure that health insurance becomes more important as you get older, right? I mean, of course, things can happen when you're younger, but things tend to happen more at a greater frequency as we age. So make sure, even though the cost of health insurance goes up for all you business owners out there and all you independents, I mean, that are not covered by an employer plan, the cost does go up. It does go up. It's expensive the closer you get to retirement, right? Until you hit Medicare age, you're paying out of pocket for these healthcare premiums. But you have to do it. It's a necessity, because it just takes one time where you need to go into the hospital. I mean, these insurance companies are in bed with each other in the hospitals, and they are charging hundreds of thousands for stays these days for a small surgery. And if you're not insured, and you have a fracture, some kind of something happened, and you need the surgery, you're going to pay for it one way or another, right? You're going to get it. You're going to have to tap an account, or you're going to have insurance. So please have that insurance. Long-term care, something I mentioned earlier, it's an insurance that covers you as we age. If you can't do two of the 6 activities of daily living, and this type of insurance is meaningful. You also get if you own a business, you can deduct the premiums, which is huge. So you can cover yourself for relatively inexpensive. Yes, you have to earn the money, but if you have a business and you're making money, you can deduct those premiums. And the third thing is life insurance. If you have a mortgage, if you have debt, and you have a family, up until your kids turn 18 and you're the breadwinner, and you're not properly covered with life insurance, please review that with a professional. And if someone's available, I can be available, but talk to somebody about it. It's an important liability that if something happened to the primary breadwinner, and they're leaving there's small kids and there's a mortgage. I mean, what's going to happen to your spouse? What's going to happen to your family? I mean, I said this before, like, if you don't like your family, don't get insurance. Like, we can leave them in a whole mess of a soup bowl of a mess. but most people, that are in families, but JC and Clem, you guys, there's a glaring problem in society today, because only 14% of Americans have $100,000 in an investment account. I mean, there's 78% of Americans has less than $50,000. So it's, this conversation is great. And we're going over things that we're talking about what a lot of people have heard over and over again. We can hammer it. But, what are some solutions we can offer today? Maybe, Clem, we can talk about this, is like to kind of get through to people that, hey, this is not a small thing that we can just brush over. People are living paycheck to paycheck. It's hard to understand what it takes to save money, but it can be done. Is there any kind of suggestion that JC, you or Clem have to kind of nail down the importance of saving?
I'll speak on it. I learned a long time ago that the importance of saving is, just like you said, generation. I mean, making sure that the next generation is going to be taken care of, but most importantly, making sure that you, as you age, because you never know what could happen. I'm telling you, anything can happen to you. You can get laid off, that's another thing, or whatever. And if you haven't saved properly, if you haven't planned properly, you have nothing to fall back other than unemployment, and that's only for a little bit. So it's important to think about all of the potential issues that could happen. And hopefully none of them do happen. That means that you have a nice nest egg. So I think it's important that you always keep that in mind. And one of the things we're going to talk about later is always paying yourself first, as one of the plans that I started with myself a long time ago. And so we're going to talk about that, but we're going to take a station break right now. But when we get back, we're going to dive deep into how a person can go about preparing themselves and having a nice nest egg and being able to not worry about a whole lot of things, because planning, right mindset, you, and remember, is your life. And we'll be back shortly after the break.
There's more stories of greatness to help you overcome adversity coming up on It's Your Life with James Cooley.
There's much truth in a journey that ain't over.
Hello, welcome back to the James Cooley Show. It's Your Life, and I tell you, this is such an important topic that we're talking about, and I want to get off into some of the things, some of the recommendations from both you and Dr. Clem, Josh, on what a person probably, some of the ways that they can save and start developing the right mindset for ensuring that they are at least planning for retirement. And so starting with you, Josh, you mentioned there was no certain retirement age. How do a person estimate how much money they might need for retirement? And I know it's kind of hard because time, travel, future, the value of a dollar changes all the time. What would be some of the recommendations on you advising a person how much money they might need to have?
Sure, great question, because it has a relevance to how much income you're going to need in retirement and how much you're going to need to save along the way. We've got a lot of things to consider. Among them is obviously healthcare premiums, because if you qualify for Medicare, you're not going to have to pay for health insurance anymore, so you can subtract that. If you're a business owner, you can subtract payroll taxes, and those certain taxes and deductions. You're not going to have those taxes anymore. If you have your home paid off at a certain age, most people have a 30-year mortgage. If you're, let's say, 35 when you buy your home, and now you're 65, you have your home paid off, then you don't have to consider that. So there's a lot of considerations to go into what percentage of your income will you need to sustain your lifestyle in retirement. A lot of people want to travel when they retire. They want to have extra expenses. They want to go on cruises and big trips and things like that. And that's okay, as long as you plan for it. So talk to somebody. It's like the financial consultants, people are leery of because we charge fees, and there's examples in the media of how they have been taking advantage of people. However, I'm an independent, so there's a lot of independent advisors out there. In fact, I'm with LPL Financial. We're the biggest independent broker dealer in the nation. I think it's there's over 24,000 advisors. So I have my own company, Goldsmith Financial, through them. So they're my broker dealer. They do the compliance and the field supervision, and they handle my trades and things like that. But the advice I give is from Goldsmith Financial, right? So it doesn't cost a lot to get a plan in place. In fact, some advisors just offer that as kind of ancillary, addition to the general services that they offer. It's very important to talk to somebody about it, and to kind of bounce off your ideas. Hey, I'm thinking about saving 70% is what I came up with. Does that jive? Is that correct? Is that something? Well, you also have to count in something very, very important called inflation, right? Something we hadn't had to deal with a couple of years ago that just kind of reared its head. And now everybody knows about inflation, and the sky is falling because there's inflation. Well, guess what? Inflation is nothing new. The average is about 3% over the long period of time, and we should account for inflation. Then we can account for someone's portfolio return, and then we can use the discounted numbers and say, okay, if you want to leave some money to your kids at the end of your retirement. If you're 30 years old today, you want to retire at 65. Now we got 35 years. We can account for inflation and portfolio returns, and then from age 65 to, let's say, retirement ends at 82. We want your money to last, so we can account for future dollars in your income. How much a dollar today is going to be by the time you retire, at the end of your retirement. So make sure that your money outlives you, not the other way around. These are relatively simple calculations that can be done by professionals, that don't cost a lot to get, and anybody can get. These are attainable by everybody. I just want to make sure everybody understands that. These are if you're not capable of doing the calculation, I give it away. Because it's that important. And if you don't want to get on a plan to help yourself and your family, that's the most important here. That doesn't cost a lot. Our fees come from, a reasonable advisor will charge for assets under management. So the more money you make, then it gives us a raise, and so that's a reasonable advisor fee. Where it equals about 1 to 1.5% a year. So, if you have, $100,000 and you need it to grow, you're paying $1,500 a year, for somebody that can help you guide you in a portfolio that averages, let's say the goal is between 8 and 12% a year. You get 8 and 12% a year, and you get all these other services, like you get these calculations, and you get somebody to, bounce financial ideas off of. You have to have an advisor on your team, as possibly your umpire, that can also direct you to estate planning services, life insurance services, health insurance services, long-term care services, and general attorney services. And most advisors are well connected in good advisors, I should say, are well connected in the community. They know the leaders of the community and what's going on in their community, and the professionals to help their clients in the community. Very, very important. Long-winded explanation there, JC.
So I'm gonna turn it over to Dr. Clem. Let him pick up the host duties for a little bit.
Well, I agree with what you said, Josh, and one of the things I'd like to stress, and I'm the client piece of this, having a financial planner, having a financial advisor is important, and because anything you do, you need a vision, you need a strategy, and especially for the young people. And then as you get older, and it's not play money once you get older. If you've been investing since you're young, it becomes real money. You need a professional that can help you to manage that portfolio. And people like you, Josh, it may seem expensive in the beginning, but in the long term, all of those funds are sucked into how much you benefit on the back end. But
can I compare it to? Okay, go ahead. Did you complete? I want to interrupt.
But one thing I'd like to put into perspective is when we talk about putting away retirement funds and talking to a financial planner. And these are some of the things I've ran into over the years from when I was like 18, 19. I get with a financial planner, and the financial planner sits me down. They look at my budget. They look what I can afford. And then I start investing into my future for what I could afford. Back when I was young, it wasn't a 401k. It was an investment account. That was fine, but that was bad, because later on down the line, life has had its way of coming in, and the only money I had was the money that I had been investing. So the way I mitigated that was I figured out how much money I needed for investment, and then I figured I was young when I did this. I was only 22, so I figured out how much money I don't need, and I never miss. And I took that amount of money and I put that into like a retirement account. And then the rest of the money that I could use for investment, what was left over, back to what you were saying, Josh, now I started looking at other markets, stocks, bonds, and stuff like that. What that did for me was, as these things, just like you said, as things came up in life, as they always do, and I didn't have enough money to take care of things, then I had other accounts that I could go to mitigate that, and never had to worry about my retirement savings, because I already had other accounts that I could take trips, I could do whatever I needed to do. So it's important, especially for our young people. Don't spend all your money just on retirement accounts. Focus on the current. Dr. Cooley, what would you say for an older person that is looking on still investing in their retirement, but still having an active account that they can turn to if there's an emergency?
I would say, you got to live, but you put aside the money that you're going to live off of, and not mess with the risk. So you set aside kind of like a budget, if you will, that you can adjust to living off of without actually going into your reserves, and stay in your lane. I mean, you don't have to try to keep up with the Joneses or any of those folks. And so you just have to develop the right mindset where you got enough money set aside in a budget form what you guys are gonna do, but you gotta live. And so, but we got to take a station break right now. But we're going to come back because there's a couple of questions that they're asking Joshua Goldsmith, and we're going to get to those questions as soon as we get back. And this is such a wonderful discussion that I hope that our listeners are learning a lot, because I am. So I tell you what, if you want to be part of the conversation, all you have to do is go to the comments, ask any question that you might have, or pick up the phone, dial 1-866-577-2473. It's your life, and we'll see you shortly after the break.
There's more stories of greatness to help you overcome adversity. Of tomorrow.
Cooley. I am the founder and CEO of the Cooley Foundation, Options, Opportunities, Lasting Choice Program. Our primary mission is to help build a foundation of our youth and young adults and communities. And we encourage everyone to dream big, think big, and be big at everything you do. And the way that you do that is, first of all, you got to believe in yourself. You have to believe in yourself. You have to know that you are here for a purpose. You also have to be able to step out your comfort zone and do things that you probably didn't think that you can do.
Dr. Cooley is here to equip you to strive for greatness and overcome adversity. It's time to get equipped today for the challenges of tomorrow. Now, here's the host of It's Your Life, Dr. James Cooley.
Hello, welcome back to the James Cooley Show. It's Your Life. We're talking about preparing yourself and having the right mindset for setting aside money for retirement or money for a lot of other things, money for emergency, so that we'll be prepared for any circumstances that we might have. But before we go on, I have to tell everybody about my new book, A Black Man Point of View, Mind, Body, and Soul. And I tell you, this book right here went released number one bestseller. And it's a lot of people look at the title and say, well, it's just about Black people. No, it's a roadmap on certain things why a Black man think the way that he do from the past generation, 400 years ago, et cetera, et cetera, et cetera, to getting the understanding that you have to let the past go, but don't forget it. You have to forgive. You have to learn to love everybody, regardless of what happened in previous generation. It's all about love, not hate. It's about respect. So A Black Man Point of View, Mind, Body, and Soul. Go out and get us a roadmap to help understanding of people that we might not understand. And you can get it at Barnes & Nobles, Amazon, anywhere with books. So I want to get back to this great topic because I think it's so important that we do have an understanding. And first of all, before we get that, Charles Gore got a question for you, Josh. He asked you, Josh, what happens when you are losing money in the volatile market or even in a private portfolio?
Great question. Before I get to that, JC, I just want to say congratulations on your book. And congratulations on such a great show. I've seen the show from its inception until now, and over 18,000 subscribers. Is that what I saw last? My goodness,
Oh,
that's so exciting. Congratulations.
we approaching. I say in 2 days we will have 19,000. So
That's incredible.
it's picking up steam.
Yeah,
Thank you.
no, and if it's your first time watching the show, I say tune in every day, because there's always something interesting to see and to hear, and something that's going to benefit you. It's just about the title. It's your life, and I love it. I love everything about it. So including the people behind it. So so congratulations on that. As far as the question, okay, Charles. When you're in a volatile portfolio, and if it's something that you cannot stomach, it's something that you need to reconsider, because if you're losing money, well, first of all, you don't lose money until you sell. So let's say you own a share of stock A, and stock A, you bought it at $20, it goes up to 30 in the first year, and then the second year it goes down to 15. Well, you didn't lose $5, or $15. You didn't lose anything unless you sell. That stock may then go up to $40 after that, and now you're back in the green. So sometimes you have to ride it out depending on your age and the risk profile that you chose for that portfolio, or that was chosen for you, as far as the portfolio that was chosen for you. And you have to stick to your long-term goals. Reassess. The number one thing is talk to your advisor, or if you're your own advisor, reassess your goals and what was going through your head when you entered the trade. Most important thing in investing is to understand what your exit strategy is, because it's easy to buy an investment, very easy. If you have the money, you can just buy it, right? But if you don't have an exit strategy, why are you investing? What are your expectations? What are your time horizons? Very, very important is to identify how much time you want to put in, you want to tie this money up for, and how much risk you're willing to take. So there's a ways to measure it. The risk against your, with your time, and against the market, and to find out how much risk you're actually taking. See the follow-up question: are the fees still the same? Fees are generally, it depends on how that advisor is charging. So if it's a brokerage account, it'll be a fee per transaction, and if it's an advisory account, it's a fee by assets under management, an annual fee that stays the same. So it gets bigger as your account gets bigger in that case, and so your advisor is, if you were questioning his motivations before, you definitely know that his motivations are there. He wants to see your portfolios grow.
JC, can I caveat on to that first question about the stocks? From an investor point of view, I'm researching my stocks, and I'm ensuring that, I'm following that stock. And if that stock goes down, I'm cheering. I'm happy that stock is going down, especially, and for those viewers that are new to investing, write this term down, especially if I'm investing in a DRIP. That's a dividend reinvestment program. If I'm investing in a DRIP stock up under that type of strategy, or I'm doing a continuous investment in that stock, and I know it's a good stock, and that stock goes down, that means you're buying more. And then when that stock goes up, in a lot of cases, you're not coming back up to where you went down at. You're coming up to a third, 2/3, and sometimes even double of what your investment was. So stocks are long term, and what your financial advisor should be advising you on is the trend of the stock. And if the stock has a good trend and it goes down, you're great, because that's the time to continue buying. But one other thing I'd like to add about investing is the way that we look at two things. One is voting, because voting has an extreme impact on your retirement. And other is how you look at what is called entitlement plans. And I don't want to get politics around that. But just keep in mind that what Josh is saying, that, you know, a lot of people only have $50,000 in the bank, and a lot have a whole lot less than that. The entitlement programs are for people like that, and all of us invest in it. And those of us that are young and working and out and doing your own thing, FICA and Social Security are not your enemy. They're your friend. Because at the end of the day, that's a retirement that hopefully you'll get a benefit based on the longevity of your work.
Can I piggyback on that, Clem? That's great. Very well said. You know, and I know that we're coming up on the end of the show, so I want to make sure that this is mentioned. Is that in the beginning of the show, I was asking why 78% of Americans only have less than $50,000 saved, and one of the answers that I am aware of is that we have been sold an idea of our own financial success, and that involves credit. And it doesn't. It's not. I mean, we've been sold this, and we continue to be sold it. I mean, American Express spent $2.8 billion in advertising in 2019. Okay. So if you're out there thinking you have an American Express card in your wallet and you think that you're smarter than them, or you're smarter than any of these credit card companies, you're not. Their goal is to put you in debt so that they can make a profit on your back. And there's billions of dollars going out of there's which equates to hundreds and thousands of dollars per individual. So just think about that as far as, you know, what your financial future is, and if it needs to include and continue to include debt, because true wealth is created when there is no debt, from a platform of, I own my house, I own my car, I own my life. And it does something mentally, and it does something psychologically to your own actions, to every action, when you have an emergency fund put away, money in the bank. And, you know, I see you shaking your head. Yes, JC, you want to add to that?
Absolutely. And one of the things, real quickly, I know we got 3 minutes left in the show, less than 3 minutes, is a plan. Always pay yourself first, if you can. Always pay yourself first. Secondly, if you're working, if you got a 401, if you can, max out. Start maxing out every single year. Third, try not to keep up with the Joneses. I mean, you don't have to. Just because they're doing all these things, you don't have to do it. And fourth, just like what Joshua just mentioned, you know, if you get a chance, buy you a house. I mean, don't become a lifetime renter, because you paying somebody else's bill, you making them more money. Take the effort and the time to go out and spend the money and buy a house, and so that you can have tax write-offs, so you can get equity in the house, et cetera, et cetera, et cetera. You know, we're down to the last minute of the show. This has been such a fantastic show. 10 seconds, Josh. What is one takeaway that you might have?
My main takeaway is, I guess it's going to be the theme is that take your credit cards, walk over to your shredder and shred it, and see how your life changes. It's going to change, and it's going to get better.
Takeaway.
We need to have a show on debt and the falsehood of, if you are $100,000, that you have to pay $100,000 in debt. We got to give our listeners the actual view of what debt and credit really is.
I think we need to do this again, both of you guys. We need to come up with a show and just educate the public, you know. So, hey, I want to thank both of you guys for taking the time to come on the show today. I'd like to thank Dr. Michelle Cooley, for putting together another great show. I'd like to thank my producer, Todd Pirate, KCBQ. Most importantly, I'd like to thank our viewers and listeners for tuning into the James Cooley Show every day. I tell you, always dream big, think big, most important, be big at everything you do. We'll see you tomorrow. Same time. Same day. It's your life.
Thanks for joining us for the James Cooley Show. It's your life. To learn more about Dr. James Cooley and how you can support the